And one of the things that is really challenging in this cycle is that you have a circumstance where we have not seen a traditional business cycle really since 2000, and even that was a bit of a bubble pop cycle more than, it was a bit of traditional cycle and a bit of a bubble pop. So what are we talking about? Like late 80s, early 90s is the last time we've had a more traditional business cycle. And I think in that context, it's very uncertain. There's a lot of uncertainty about how all of these dynamics play through. Like the US economy, as an example, restructured substantially following the financial crisis, a move away from floating rate mortgages. A lot of companies basically went from borrowing on the short end primarily to extending duration, locking in low interest rates for a long time. And so there are reasons on that side why you might think that the sensitivity of the economy is lower today to interest rates relative to what it was in the past. At the same time, debt levels are higher than they were, certainly in 2000 or back in the late 80s and early 90s. And so you may think the economy is more sensitive to the interest rate dynamics. And so you see these big cross-cutting forces. And frankly, the big thing is it's unknown. It is anyone who tells you it is certainly this way or is certainly that way is too confident. Mm-hmm. There's a lot of ambiguity. So what is the right terminal rate to start to ease inflation pressures? It could be 3, it could be 5, or it could be 7, or it could be 11. Mm-hmm. It's hard to know. And so in a lot of ways, when you're navigating through this cycle, the key thing that I think you have to do is you have to hold very true to the data and what you're seeing in the data, because it's giving you feedback on here's how much they've tightened, here's how it's flowing through. Is it actually doing enough? Is it not? And how is that working? And you got to operate agilely in this environment. You can't just say, well, there's been a lot of hiking and therefore, and the yield curve's inverted and therefore, you know what, we're going immediately into recession. The reality is lots of people who did that have gotten burned because they used, frankly, indicators and dynamics that had existed years and years ago to try and assert certainty around the fact that we were on a certain economic path. And the reality is that it's a lot more ambiguous than that. So that's probably an unsatisfying answer to your question.
Well, I
think
there's
a lot more uncertainty than there was in the past.
I think the basic premise that we should take from that answer is, as you said, we have to be nimble and we have to keep learning, right? We have to keep our minds open to continuing changes within the economy and each of these inputs and how they affect every piece of the economy.
Exactly.